inflation is the ultimate end game here. I think the word is inflation, whatever it takes. I mean, that is, I think, where we're headed, because when you look at the unfunded liability pile, there is no way in hell we're ever going to be pay this off nominally unless we devalue the actual currency unit. Kyle Bass in 2011 sat there and said, I talked with the administrative, high up in the Obama administration, and was pressing him on how we're going to get out of this. And the guy ultimately said, we're going to kill the dollar.
Joining us back on Wall Street Silver is James Anderson from SD Bullion. How are you doing today, James?
Ivan, I'm doing well. Thanks for having me back on. It's a pleasure.
Awesome. Well, we appreciate you for taking the time out of your day to talk to Wall Street Silver.
Well, Chris Marcus was speculating that it's the memes that could do this, because guys like Jeff Christian or who's that guy at the CFTC, or they'll get tired of just being the butt of jokes. Maybe they'll just want it to all end, and that might help push this over the edge.
I mean, ultimately, getting back to the point, it is the physical demand outsized, not just from the retail customers like you and me and all of these guys buying one case, two cases, but it's the collective activity of that, kind of growing. As you can see, at Wall Street Silver's at 108,000. You were just at 100,000 the other day. So, there's 8,000 new apes, who are getting fully informed and enjoying the memes and sharing and having fun. It's also the family offices. It's also, the high net worth investors in the United States who are looking at the monetary base that's exploding, the M1, M2, M3 piles that are just ramping up, even on logarithmic charts. They look scary.
Let me share one of those while we're talking about it. This is the monetary base. What is this one? M1.
That's M0. That's the hardest measure of the fiat Fed note base, and you can see, since COVID really kicked off, we've doubled it now, more than doubled it, from below 3 trillion to now over 6 trillion. And I know people are going to say, well, it's not being put out into the, the system, and the velocity of currencies not turning over, and you need that to have inflation, et cetera, et cetera. But, yeah, that's true partially. But what happens when people's confidence starts really breaking? I mean, I know personally, I don't like to keep huge swaths of cash sitting around. I know people argue for dry powder, I guess, if there's like a drawdown in the stock market, et cetera. But I personally feel like, we'll be walking into years where the fiat Fed note loses 10% or more versus, real goods and services. So I don't like to sit around and just lose that much purchasing power by holding an inferior store of value. And so I think we're dealing with a crisis in confidence, partly, as well as eventually a turnover in the velocity of currency, because it's pretty obvious they're going to be handing out fiat Fed coins probably in the next few years. And there's going to be some type of MMT type situation where they're going to be giving it out on like a quarterly or monthly basis to, lower income families. And those people spend that currency. They spend that currency and put it right back into the economy very quickly. So what you could have is something that kind of gets away and gets out of hand quickly, and the inflation can really get going.
Well, I've put up another graph, another spreadsheet that you sent to me, showing M0, M1, M2, M3. Right. And actually, the Treasury discontinued reporting some of this data earlier this year, which was kind of alarming. Something they've reported for decades, they just halted.
They changed the way that they defined M1 too. So that if you look at a chart of late, it just goes straight up a wall. Even on a logarithmic chart, it goes up straight up a wall. It's virtually M2 now, the way that they define it. So the thing I pay most attention to is the M0 hard physical, fiat Fed note bills that have been created and issued, and that's over 6 trillion now. And this is just a simple, crude Google document that I use to kind of keep track of the long-term target. And this long-term target for me is the 40% gold bagging target. And this has happened. This has happened multiple times in U.S. history. The most recent time it happened was the late 70s and into the early 1980s, when we went 100% gold backing, meaning that all the M0 that was out there could have been was the same value, or or a little bit less than the entire value of the U.S. official gold reserves. And so in the early 80s, we could have gone theoretically back on a gold standard if we had so chosen. But, we had a Cold War to battle with Russia to outspend them. So we decided for other things to do at that time. But in 1933, 1934, during the confiscation of gold, in the nationalization of private gold coin, they under coercion, they essentially threatened the population and said, turn in your gold to the local Federal Reserve branches under threat of $10,000 fines and imprisonment, et cetera, et cetera. And I've done the research on this. It was many years back, and since I've lost the data, but it was only like a third of the population and the actual coins that have been struck that actually got turned in. Like 2/3 of those coins got hoarded and saved. And, you weren't supposed to have more than 4 or 5 ounces per U.S. citizen over that 1933 to 1975 timeframe. But there was a lot of people who ignored it and just kept their gold, quietly. And those coins are still around. They're still sold by the boiler room shops as semi-numismatic coins. They're not that rare. There's a lot of those coins that were hoarded and people ignored what the Federal Reserve said. So, I mean, in that time frame, we did jack up the price of gold from $20.67 to $35 an ounce. That's a 70% devaluation of the fiat Fed notes purchasing power in gold terms. And doing that covered over 40%. That's the precedent I think we're going to see again. And so that target is now over $9,000 an ounce gold. And that's only to date what they've created in the M0 pile. I mean, a few years out from now, the M0 pile could be 8 trillion, 9 trillion, 10 trillion.
Mm-hmm.
You pick the number. Every time they jack it up, it makes that target, that long-term price target, higher. And that long-term price target is basically a price target that is based on basically the U.S. citizenry's market force, their market force of not having confidence in the issued currency that's out there, and their stampede into bullion. And that's what's going to overwhelm all this derivative rigging that we've been seeing.
Dan Oliver, who we interviewed about a week and a half ago, 2 weeks ago, he was making that same argument, of explaining how we get to 10,000 gold and why it's not crazy, that 40% backing easily gets you there. Mm-hmm. And at times we have had 100% backing of gold to M1 or M0, right, where the market basically took us there. And
the early 1980s is the last time.
It's rare, but every couple of decades, a crisis in confidence gets us there. He's betting that we're headed there again at some point.
If you look back, Jim, it's like a 50 to 60 year cycle. Even after the U.S. Civil War, and they issued all those greenbacks, those fiat greenback notes, there was a mania in gold in the late 1860s in New York. The price of gold went from $20.67 to as high as $180 in the late 1860s. Okay. Wow. Silver performed well too. It did multiples, I think, a few years prior to that. But there's all these conspiracies as to why it happened, and there was all these excuses as to insider manipulation, and the president's one of his relatives was involved, et cetera. I forget how the story and the conspiracy goes. But the bottom line is that people were freaking out. They didn't want to have greenbacks, and it jacked up the price of gold into a mania. And I'm not saying, we're going to see an 8-bagger from here, but these things have happened before in U.S. history, and they happened roughly 60 to 50 years. 1980 was the last time. So by 2030, we'll be on course, so sometime this decade, we may be seeing that play out.
Well, the greenback totally disappeared, didn't it? And they reset the currency.
I mean, they did pull it back to $20.67 after they demonetized silver, and basically, pulled the rug out of the people who moved out west, all the farmers and people who had debts in gold. They in silver, they had to turn around and pay it in gold, so it was a lot more cost prohibitive for them when silver got demonetized. Okay. So it was a consolidation of the banker class over the productive class. It's a common battle that's still going on and raging today.
I think we've had consolidation of the banking class since this nation was founded. But anyway, getting back to the COMEX situation now, and the spread between what you pay at retail for an ounce of silver to what you pay, in a spot price. Why do you think the market has not gone up? Why is the spot price stuck? A lot of people talk about manipulation. Do you think that's it? Do you think there are other factors involved?
So I looked before this interview earlier today and I was looking at the timeline on Twitter. This guy had a funny tweet. I forget his handle, but it was a funny tweet where he said, silver's going to spurge to 27.9999999. Look out, look out. Like saying, just making a joke about how it keeps hitting the 28 level and just dropping down, down.
Happy Hawaiian's been commenting on that the past few days also.
Oh, God, it's super frustrating. And this is the type of thing when if you're watching the spot price every day, like hoping for it to break out, it's going to wear you down. So you got to kind of take a longer term perspective. I remember 2009, 2010. Now, if you remember early 2009, silver spot was, it dipped below 9. And this is, right after one of the worst banking crises we've ever had in the country. And they started to do the quantitative easing program, et cetera, et cetera. So you had a $9 spot or high $8 spot at the beginning of the year. And then it got into a range where it ran from like 15 to 19. And it started in that range September 2009 and ran all the way until September 2010, where it finally broke out of that 19 level and started moving up in the mid 20s. And then it took off in the mid 20s up to 50 very quickly the next year. So it was in a range for a year. And I looked just now, we would be on course to be in this range from like 30 to 24 for roughly a year by the time August comes around. So my hunch is, if past this prelude, that's probably what we're going to see again, something similar.
We got time to stack.
Look at this. The high today is 27,991.
Yeah.
The high yesterday, 27,999. The high 2 days ago was 27.972.
Yeah. I mean,
before that, 27.949.
What that looks like is somebody set up an algorithm that says every time 28 gets hit, it just trips off this massive sale volume.
Yeah.
And so what you're seeing here is that, that's essentially what it looks like.
You can see it.
Patrick Karam, Bad Charts, he told me just to draw this vertical line here. Forget this lower trend. He says, draw this vertical line right here at like 28. I think I said it at 28.18. And that, yeah. So let's pull this back out here. And this is the graph I'm watching here. This is going back to last year. This was the virus collapse right here. And you saw we just built up all this pressure at 18, the high 18 area. And then when it broke, it just rushed straight up to 30. We overshot, this line right here is at 28. We overshot to 30. And then we've just been back here playing around below 28. This was Ivan fucking around back in late January, early February with the Silversqueeze. Briefly got it above. But you can just see this pressure building.
And when you see on a technical chart, when it's very tight like that in a coil, that means it's building pressure. We're getting set to blow off, it looks.
Ready. Well, we're basically, this is the classic W, right? I don't know if you guys know to look for that, but the classic W below the line and with higher lows every time.
Yep.
And it's just, when it breaks, boom, this is my OCD charting complex right here. In order for this to look pretty, it's got to go up about the same amount, right? So I think we're going to I have this line set up at 38. We're going to overshoot to 40. And then we're going to come play around under here, under 38 for 6 months. That's my prediction. And if it goes any other way, I'm going to have a big problem with that, just because with my OCD. But just letting you know,
Jim, the one caveat I throw in there is, we just don't know when the next deflationary bank collapse, financial failure that comes about, that sets off a deflationary spell again, where then they have to come out and burr more and create more currency. So when that happens, there will be deflationary sell-off, but you won't see it in bullion. The bullion prices will stay, just like they did in the COVID, March, April phase in 2020, where all of a sudden, the gap out in premium just kind of stuck and the spot went down, but you couldn't get bullion below 20, even though 12 or 13 was the spot. We'll see something probably similar like that, even if there is a deflationary bust in a couple of years coming. And I expect that. I expect that ultimately this culminates in some type of major structural change. And in that structural change, it's going to be a lot of deflationary force, which will get overran by the fiat currency creators. They will overrun it, whatever it takes, essentially. And they will make this happen. I think personally, they will make an inflation come about one way or another.
That leads into sort of the inflation discussion. Today is June the 10th, and we'll probably run this tomorrow just so the audience knows we're talking the day before. But, today we had the big consumer prices surging with the headline number at 5% year over year, hotter than the 4.7%. And this is only if you really believe CPI is even real. I think a lot of us believe we're closer to 8 to 10 or even higher. in terms of our real inflation these days.
Right.
What do you think? Do you buy CPI?
Well, CPI has essentially been rigged since 1980, and the government, the Bureau of Labor Statistics, has a real reason to want to do that. I mean, the real reason is they can pay out less in Social Security if they have a CPI that's understated. And so, you know, if you go and look at the machinations of how they count the CPI, it's like, it's ridiculous. Some of the things they use, where they don't really use good high quality food, the prices of good high quality food that stay healthy. And they don't use, you know, in terms of real estate, they don't use average middle class real estate. They always supplant it with things that are lower, so they can understate the actual inflation rate. So yeah, I'm of the belief that we have been running about 2 times or 3 times what they've been claiming for the last many decades. I'm talking since the 90s. All right. So think about that. If you compound 5% of lies decade after decade after decade, that's going to add up to some real price inflation. The only thing that's kind of masked it has been, you know, the main thing that's masked it has been technology advances, you know, our ability to be more productive and to be able to do more with less input and less capital. But ultimately, you know, the price of goods and services has gone up way higher, I think, than the CPI has claimed. And you'll see that come to truth when you see precious metals finally get released and get running in a real free market style toward a free market price. And that, I think, is going to scare a lot of people. It's going to really scare a lot of people. I mean, you have a situation where Bitcoin is priced at $36,000. It's been as high as over $60,000. Thank you, Bitcoin, because you know what you did? You helped break the perception that $10,000 gold is unobtainable. I mean, in a world where Bitcoin is worth that much, I can totally understand and buy into the idea that gold could easily be $10,000.
But at the same time, when Bitcoin goes to 60, no one really cares. You know, it's just rah, rah, rah. It's news on CNBC. People get excited on Twitter. But the banks don't really care because there's no real, who was it who we interviewed who made that comment that there's no Bitcoin or the cryptos, they have no real connection to the tangible world. There's no, I think maybe that was Dan Oliver, but there's no, Bitcoin is more of a speculative asset. It's not really connected to the price of energy. Like gold and silver, there's a cost to mine. There's a cost in the form of diesel. There's a cost in the form of rubber for all the tires. For you got to buy all that equipment from Caterpillar. There's a real connection to the real world in terms of mining for hard assets. That's true with every commodity. If gold or silver actually started going crazy like that, you know the shit's hitting the fan. So it's I don't think the real world gets excited about. Well, the real world does get excited, but it's not that same sort of crisis atmosphere when Bitcoin goes to 60,000. Gold goes to 60,000, people will be terrified.
No doubt. It would definitely, I would never want to see that, because that means we're probably moving into a hyperinflation, and that would be the last thing you'd want to live through. I don't think anybody would want to live through that. That would be horrible. So, you know, the hope is that somehow the, you know, unfunded promises that we're not going to deliver on, we default in a orderly manner in a way that is, you know, somebody's going to have to hold the bag. There's going to be a lot of bag holders. I mean, there's no way we're getting out of this with, you know, without scarring. The key, just to bring it back to my personal experience, I lived for about 7-8 months in 2003 and 2004 in Buenos Aires, Argentina. It was right after they had a situation where their currency, the Argentine peso, was pegged 1-to-1 with the US dollar in the 1990s. And they lived high on the hog in the 1990s. And then all of a sudden they devalued the currency 3-to-1, and then it was 4-to-1 at a peak, you know, when I was there. And to see the psyche of these people and the lack of belief in the institutions in their country and what it did to them culturally and in trust levels with one another, you don't want that. That's going to be a horrible place. You don't want to live in a low trust society. And that's sadly what's happening here in the United States more and more. It's a low trust society.
But, you know, it's sort of becoming, it's almost unavoidable. And I think the key difference is it's never, maybe I'm wrong. Has it ever happened with a world reserve currency? World, I mean, every world reserve currency loses its status. It happens every 100 or 80 years, whatever. First, it was the British pound. It's been the French franc. It's been the Dutch guilder. It's it's been various other currencies throughout the centuries.
Sure.
But has that ever been did they collapse when that happened?
No, it was a transition between the British pound to the US dollar. And in that transition, Britain went off the gold standard and they had a huge, terrible inflation in the 60s and 70s. And, you know, it's the oldest surviving fiat currency, and it's been a full fiat currency for like 80 years or so. But it's been debased like crazy. And originally the British pound was 12 troy ounces of silver. And
yeah, the sterling,
you know,
pound sterling.
Pound
right?
sterling, right? I mean, and if you go back and look at the numbers, it's devalued versus silver like 99.5% over 400 years. So, you know, that it's the same thing when gold passes 2000 fiat Fed notes. Since 1913, that's a 99% devaluation of what it was before. It was $20.67. You know, and gold eagles are selling over $2,000. So, you know, the U.S. did it in roughly the same similar time frame, a little bit quicker than the British pound sterling did it. We did it in only 100 years, and they did it in, you know, over 400 years roughly.
James, how are precious metals perceived down in South America after having such experiences? I mean, are people much more likely to hold them?
Yeah, in Buenos Aires, even in 2003 and 4, there were local coin shops and places where people could go and buy, you know, old gold coin and old silver coin. And I assume the most astute would do that for long-term savings, but also people will have offshore accounts in euros and fiat Fed notes and other, you know, major currencies, and they'll have it offshore because they just simply don't trust the banks within the country because they've proven themselves to not be trustworthy. And so the rich and the wealthy, it was this weird situation because most of the people in 2001 and 2 that were in the government and in the banking system all knew what was coming, that there was going to be an overnight devaluation. And so what they did was they all moved their currency offshore and their capital offshore. They waited for the devaluation to happen, and they moved back their currency back onshore, and they tripled their purchasing power effectively by getting out of harm's way. And those who are on the outside, not knowing the inside information, were trapped in what they called the corralito, which was essentially, you know, a corralito. Their transfer, it basically is like a slaughter pen. And so the masses were in the corralito, which means that their dollar bank accounts in, you know, the banks there were in the corralito, and the government said they're being switched to pesos at 3-to-1 exchange. And so those people lost 66% of their purchasing power, and to add insult to injury, withdrawing in only small rations that were controlled. So they couldn't pull effectively all their currency out at once. No, they could only pull it out in small rations. And so when I would walk around town there every day, you know, you'd have to duck into the subway to avoid the protests that were coming in droves. Thousands of people from small towns would come in. You'd hear it coming and be like, get in the subway because you'll be stuck in traffic if you don't move. And there would be people standing outside of the banks at lunch, banging pots and pans on the sheet metal that surrounded the banks, spraying graffiti, etc. So it was an ugly situation, and don't want to see that happen in the United States. I mean, the United States is obviously a lot larger of an economy than Argentina, and Argentina has a regular cycle of doing this kind of crap in their history. I don't think it's going to happen in the United States, but I don't even want to see a fraction of something like that happen in the United States. That's the one thing about the United States, that capital is respected, the rule of law, for the most part, in terms of people's private property and private property rights, is still respected more so than it is in a lot of these countries in Latin America. And so, you know, it's capital flight. I mean, the United States sucks in a huge swath of capital from offshore because the fact that it's highly protected in the United States, and the rules are more or less rigged for the highest net worth investors to, you know, make the most proceeds. And that's why you see such a huge exacerbation of wealth, and especially in the last 10-20 years, it's been historically the largest of all time. So you know, this is exactly why so much hot foreign capital comes in the United States.
You know something, we talked with Tavi Costa. He's a fund manager with Prescott Capital. He lives in Denver now, but he is from Brazil. And we asked him that question: do they have that tradition of buying gold and silver in Brazil? And he said they don't really. Their tradition there to protect their capital is to have offshore accounts or offshore assets in dollars or euros, either back in Portugal, because there's the language connection there for Brazilians to Portugal, or to Miami, Orlando, Tampa, you know, Florida, just because it's close and there's lots of flights directly from Miami and Brazil to Brazil. So they don't have that same culture. They may have it in Argentina, but he said it doesn't exist in Brazil. Their tradition is dollars and euros.
And it's not a huge cultural thing in Argentina either. I mean, most people just keep it in the fiat Fed notes, US dollars or euros, and you know that they think is that as being a safe haven currency, and it's they don't understand that underneath that is actual just a lot of it's just fiat currency again. And so what happens when those start really having trouble? I mean, you're going to have to run to the real money and to physically go get an allocation of bullion, and that ultimately is what I see coming. You're going to see this silver squeeze lead to a gold bullion squeeze ultimately when this thing goes off. And there's so much money in the high net worth investing class. I did a video on SD Bullion's YouTube asking a question, how much silver does it take for you to be a whale, And I went through there's all these reports every year from 2 different places that do reports on high net worth investors and ultra high net worth investors. And they break out, what these various estates have in terms of percentages and allocations to precious metals. And, these are estates of 10 million, $50 million or more. And, the percentages of precious metals allocation are like 1, 2, 3, 4%. I mean, the highest ones were like India, maybe 5%, et cetera. So if you start seeing those high net worth investors go after 10% or something along those lines, it's going to make a major effect in terms of, what's going on in terms of the spot price and, who's able to get physical delivery in a reasonable amount of time at a reasonable price.
Do you think, we've documented ditch the deep state on Reddit, and I share his stuff on Twitter. He's very thoroughly documented the decline in 1,000-ounce bars off the COMEX, basically coinciding with Silversqueeze and with Sprott PSLV, where their acquisition of 1,000-ounce bars just launched. Did you by chance see that video with Rick Rule over on Liberty and Finance, Dunnigan's channel?
I did, where he started talking about the usage of sub-custodians, having to do that now.
Yeah, well, he's basically Rick. We have Rick coming on next week, and I'm going to really drill down on this issue now that I know he'll talk about it. Now that he's no longer CEO of Sprott, he's willing to talk a lot more about these things since he's just a private individual now. But he basically said that Sprott PSLV has basically cleaned out North America of 1,000-ounce bars. He says first we started in Montreal, then we went to Toronto, then we went to Chicago, then we went to New York. He says anywhere that was within trucking distance of their custodial vaults in Canada, they were buying 1,000-ounce bars from every single source, and they ran out. Essentially, they cleaned it all out. So they just recently opened up a new custodian agreement in London so that they can start going after the London sources.
You mentioned London, Zurich, and Singapore as the 3 major city centers where they could sub-account for 1,000-ounce bar allocations. And remember, this is all the float that's only available at roughly $28 spot silver, right? Once we get up to...
They're paying above. He's documented. He's paying about between 60 cents and sometimes over $1 above spot to acquire 1,000. He's basically outbidding everyone right now on 1,000-ounce bars. I say he, Rick Rule, but he's just... Right. I'm referring to PSLV and the traders.
Yeah,
there's enough demand for what's going through PSLV, and they're authorized still. They had a $3 billion shelf offering, and by our rough calculations, they're less than halfway through it. They've still got capacity through their current shelf offering to acquire another 70 million ounces, which is close to 10% of global annual mined silver.
Right. Just for PSLV alone.
Just for PSLV alone. By far, without question, I challenge anyone to find someone who's buying more silver than Sprott.
Yeah, no, I'm a shareholder of PSLV and bought after the squeeze began because I believe in that fund, and I wanted to be able to speak from first hand basis on behalf of that fund because I'm a shareholder, and I definitely believe in that fund and the people that are behind it that are being trustworthy and credible. And this notion, this new idea that they have to go out to London, Zurich, and Singapore is not surprising to me because there's only so much float at $28. Even if you're paying a premium to get the 1,000-ounce bars from Ottawa, Toronto, anywhere in Canada, and then to go to Chicago, New York, Boston. I know the warehouses that are in those places. I've seen the warehouses drop precipitously since the silver squeeze began. And it's been a combination of a few things. combination of PSLV demand and retail physical bullion demand as well that have helped drain down some of these warehouses.
What I find amazing is that people like Jeffrey Christian from CPM Group. Can you hear us?
Yeah, I'm good.
Okay, I didn't know without your headphones. People like Jeffrey Christian from CPM Group, he claims to be a silver analyst, and he puts out these videos. And I've watched the last couple of weeks, everything this guy's saying, just for comic relief. I watch this stuff, and I don't know how he can claim to be a silver analyst and not talk about what's going on this year with PSLV. How do you fail to mention to your clients
well, I can tell you
the largest buyer that has entered the market on just an ungodly level, buying one, and I estimate they're buying 1/6, 1 out of every 6 ounces that comes out of the ground. Sprott PSLV is buying so far this year.
In terms of notional intake. Yeah, I know. Yeah. There's a reason, because Jeff Christian, if you listen to him, he does a lot of ad hominem attacks on people's characters. One of his favorite targets is Eric Sprott. He really has high disdain for Eric Sprott. So anything that's positive Eric Sprott, he will never give that, away. And that's probably why he just refuses to even acknowledge the fact that PSLV is climbing a wall in millions and millions of ounces of silver that it keeps acquiring. So yeah, I'm sure it rubs him the wrong way that Eric Sprott's winning, that his fund is doing really well.
Eric Sprott doesn't really own Sprott anymore. He divested completely. I know he's an investor in PSLV. Rick Rule, or I've seen some press releases, told us he recently invested $30 million or something into PSLV to help the Silversqueeze, but he's not actually running Sprott management anymore, correct?
I'm just giving you the psychological inside baseball on the man versus the other man, and what I think is really going on behind the scene, why he doesn't like to acknowledge the fact that PSLV is outperforming virtually every other ETF in the silver game. I mean, that is precisely why I think he never acknowledges it publicly.
Well, if this keeps going, here's what I'm going to predict for later this year. We got another 6.5 months to go for this year. I think Sprott's going to finish that current shelf offering for $3 billion, another 50 million, 70 million ounces, or probably before it's over, because they're going to, let's say November or October, they're going to come out and they're going to issue another $3 billion shelf offering. They're not going to stop. As long as the price is this low and people are buying like crazy to fund it, they're going to turn the Sprott vaults into the strategic silver reserve for the planet.
I mean, Jim, think about the momentum trade that comes into silver when spot climbs up, like you were talking about earlier, and goes up and makes a run at 40. I mean, think about how many people would pile in just looking at the currency creation, the inflation, this data that we saw today, 5%.
News alert. We have broken 28.
Oh,
Here comes Thiago. The 27.999 has fallen. It is 3:54 p.m. on June the 10th.
Oh, it is 27.999. I see it.
28.015. All right. I just had the breaking news, although this is recorded and won't be broadcast until the 11th.
The fact that inflation is the ultimate end game here. I think the word is inflation, whatever it takes. I mean, that is, I think, where we're headed, because when you look at the unfunded liability pile, there is no way in hell we're ever going to be pay this off nominally unless we devalue the actual currency unit. And Kyle Bass in 2011 sat there and said, I talked with the administrative, high up in the Obama administration, and it was pressing him on how we're going to get out of this. And the guy ultimately said, we're going to kill the dollar. And it's the same people who are there with Biden right now, and they're doing it effectively, slowly but surely. I mean, if you look at the US dollars, not the DXY so much, but the actual the Fred chart, I could send it to you, but it's been going down precipitously since COVID started. And, I think that's effectively what they're going after. It's just a devaluation of the fiat Fed note over time in order to nominally meet these without defaulting outright.
To what you just said, if you actually read the Fed's policy papers, they're not hiding it. No one reads these policy papers except for people like me and you. They actually state that they've already selected they're going to go for devaluation and massive inflation.
It's going to be
their policy papers.
a full monetization of the bond market. You know, the Federal Reserve's balance sheet probably going to go up to 30, 40 trillion by the end of the decade. And they're going to be buying everything that's not nailed down. And then, you know, by effectively doing that, they can prop up the bond market essentially. And then on the other side, they can devalue the currency and make it, you know, make it more nominally palatable to actually pay off.
But the other thing I think they're probably going to have to do, they're going to have to change federal law and allow bankruptcy for states. Currently, only cities and municipalities can declare bankruptcy. There are certain states they're going to have to.
Yeah.
I mean, under their constitutions, they, like Illinois, for example, they can't get away from their pension, even if there was a new currency. They've still got these insane pension obligations that no tax base under any even with a new currency, even with a gold, even with a gold-backed dollar again, and a sound money policy, they still couldn't pay the.
You're talking about you know, a front of inflation, but underneath you're going to have defaults in all types of pension programs and in various ways on the state municipal level and even private pensions. A lot of them are going to be defaulted outright as well. But on the overall spectrum, inflation and devaluing the fiat currency note is the way that, you know, the federal government gets out from actually meeting their nominal, you know, promises. But in terms of real value, it's not going to be anywhere near what people thought.
James, do you think they're going to introduce the digital dollar after that?
Yeah, I think the fiat Fed coin is probably 2 to 3 years out, and, you know, and the way that they're going to probably, you know, give it out is they're basically going to give away a bunch of free currency to people to get them signed up on their cell phones. And that's, you know, essentially how they get that extra new policy toolkit. And as time goes on, it's going to gain more and more market share, and it's going to be more centralized, and the federal government's going to gain more control over, you know, how the financial and monetary system works. And, you know, that opens up a whole new set of tools for them. They can effectively run NIRP, negative interest rate policies, pretty effectively by doing that. They can make their cashless policies more effective. They can give out currency and say there's an expiration date to use that currency. So you have to actually use it in you know, spend it some way somehow. So yeah, there's a whole bunch of new tools that'll likely come about. And I assume by the time that that's coming out, we're going to have, you know, precious metals running, you know, sky high, because if you effectively, the fastest way to devalue the currency is to let commodities just bleed, you know, let commodities just go north. And that'll really help devalue the promises that you can't keep in terms of real value. And that, you know, the progressives think that it's going to be great because it's going to help the wage earner to somehow keep up with inflation by negotiating for higher wages. But if you go back and look at history in terms of, like, I've done the research on hyperinflations in Latin America, that's a very, very tough situation because, you know, it pits managers versus the wage earners against one another. And it's very corrosive in terms of those relationships. The wage earners never keep up with the inflation. They never do.
Yeah. You know what, in terms of the Fed coin, it's my understanding the Fed doesn't have authorization to do it now. They'd have to get it through Congress. And we've been speculating, you know, we love to speculate here, as to how they would, because there's going to be a ton of resistance to something like this. It's going to be something like 2008 when Lehman collapsed, where there's just total panic and then they can just force something through. Right? As in, they're not even going to have time to read what's written in the bill. It's already, the bill's probably already written, and they're just waiting for the panic or some crisis. They're going to tuck it into some must-pass legislation and jam it through, and we'll find out after the fact that, oh yeah, Fed digital currency has been authorized.
Well, that was the same way during the COVID crisis, right? I mean, the Federal Reserve and the U.S. Treasury essentially melded under that crisis, and they're still melded under that crisis to be able to go out and bail out corporations and other hedge funds, et cetera. So, and to do it not in a very transparent way, you know, they'll say, oh, it's going to be transparent and there'll be people monitoring. Please, no one knows really behind the scenes what's going on. I mean, I don't know how many sets of books they're running, but it's certainly not what they're reporting on the Fred charts. I mean, what we're getting told is probably, you know, a portion of the truth.
Like perpetual TARP.
I'm sorry?
It's like perpetual TARP.
Yeah, TARP was 29 trillion, and it took years of wrangling in the courts to figure out how large it was notionally. 29 trillion. I mean, who knows how big this was? You know, we still have no clue.
Thank you again, James Anderson. We appreciate you so much for coming to the Wall Street Silver community.
First of all, I'm a member of the Wall Street Silver. I'm a card-carrying member. I enjoy the forum very, very much, and all the fun that everybody's having and the meme making and et cetera, et cetera. if you have interest in what I do for, for SD Bullion, come by SD Bullion's YouTube channel. I put out a market update every week, and I'll probably be putting out 2 videos per week coming up soon. The second video will probably be more FaceTime with me and a little bit more of, beginner and experienced knowledge that maybe, you're not getting across when you get the market updates. So I'll try and change up a little bit, but come by the SD Bullion YouTube channel and check it out. See if you like it, subscribe, and come hang.
I will put the link in the description.
Cool. Thanks for having me.